Good evening, ladies and gentlemen. We would like to warmly welcome you to this webinar organized by the Colombo Stock Exchange. Today, the topic for the day is revision of the ASPI calculation methodology. If you can remember, during the month of November, the Colombo Stock Exchange put out an announcement telling that there was going to be a revision of the ASPI calculation methodology. And then on the 19th of November in 2021, we did a seminar, basically another webinar, explaining this scenario and answering a number of questions regarding the revision of the ASPI. And this webinar is a repetition of that previous webinar, and we want to give a chance for our investors to further understand the scenario and also to ask more questions and get your if there are any clarifications, them sorted out, and to get a deeper understanding of this methodology. So if you, this webinar will be twofold. First, there will be a presentation explaining the calculation methodology and how the revision is going to happen. And then after that, we will go into question and answers. So we have received a large number of questions from the Google form that you all have filled, and we will try to answer as much as questions as possible after the presentation. So let's go straight into the presentation. So the presentation today will be done by Nishant Hevavitarna. He is the head of research and strategy at the Colombo Stock Exchange. So the Nishant Hevavitarna is attached to the Colombo Stock Exchange in the capacity of head of research and strategy. He is also spearheading the exchange's promotional activities of sustainability. He joined the Colombo Stock Exchange in 2011 and holds over 21 years of experience in social finance and academic research as a practitioner and academia. His research focuses specifically in the areas of equity markets and behavioral finance. Nishanta holds a BSc in mathematics and statistics in the University of Colombo, Sri Lanka, and an MBA in finance from the same university. So let us now dig deep into the presentation. Over to you, Nishanta.
Thank you, Dimanta. A very good evening once again to everyone. As Dimanta mentioned, I'm going to do a short presentation that will set the context for the discussion. Give me a second for me to share my presentation. I believe you are able to see my presentation. And the objective of, or the purpose rather, of this particular exercise is to change the weighting scheme from full market capitalization to the float adjusted market capitalization. I believe everyone is familiar with what the full market capitalization means. And the float adjusted market capitalization means a part of the full market capitalization that is available for public to trade on day-to-day basis. As you know, if you take the issued quantity completely, entire issued quantity will not be available for public to trade on day-to-day basis. For example, company founders may have held some portion. We cannot expect them to sell that in the market in general. Likewise, chairman, board of directors, and other executives and other strategic investors would hold some portion of issued quantity. Those are not really available for public to trade. Then what is available on day-to-day basis for public investor to trade is known as public holding. This is usually calculated as a percentage. For example, in a given company, public holding is say 19%. It means out of the issued quantity, only 19% is available for public to trade. Same concept can be applied to the market capitalization as well, in addition to the issued quantity. The total market capitalization is say 100 billion. if I may continue the same example, 19% of that, that means 190 million, that means 90% will only be available for public to trade. Likewise, now you can see there are two the measurements like full market capitalization as well as float adjusted market capitalization. So indices can be, the index constituents can be weighted on these two methods. The index constituent can be weighted on full market capitalization of each company as well as the float adjusted market capitalization of each company. As you know, currently the ASPI, all share price index constituents are weighted on full market capitalization basis. We are going to change that to the float adjusted market capitalization. That's the whole idea about this exercise. And so what's wrong with the current index? Current index, as I alluded, it is weighted based on the total market capitalization of each company. And the problem with that is it doesn't represent the tradability of the constituent. For example, what would happen if the public holding is very small, say 1% or even 0.5%? That means only 0.5% or 1% of the issued quantity would be available for trading purpose. However, irrespective of the public holding, current calculation considers 100% of the issued quantity as tradable. So therefore, the current ASPI doesn't represent the tradability of the index constituents. The solution is, of course, to weight the index constituents based on the float adjusted market capitalization instead of the full market capitalization. If the public holding is low, then of course we take only that portion. If it is 19%, we take 19% of the total market capitalization. If it is 85%, we take 85%. So that index constituents would be weighted on the float adjusted market capitalization. This is in very high level terms what we are going to do. However, once we introduce this change, of course, it comes in actually three components. First one, as I explained, of course, weighting scheme change. Change number one, weighting scheme. The current methodology says, as I mentioned, of course, it is weighted on full market capitalization. What we propose is to weight the index constituents based on the float adjusted market capitalization, which I explained in a while in detail. Now, second one, once we do this one, we have the problem of overconcentration. Now, imagine a situation where very large company having very high public holding. Of course, multiplication of those two would also be very high. And among float adjusted market capitalization, that company would stand out. And as a result of that, the new index would be dominated by this particular company. Therefore, we don't allow the overconcentration. We cap the concentration to the maximum level of 5%. So the change number two, capping of index constituent representation. Current methodology is not applicable. There is nothing like that. However, in the proposed methodology, we are going to cap that at 5%. Change number three, as you know, this calculation is based on the public holding percentages disclosed by the companies. Companies disclose public holdings on quarterly basis. So once the companies disclose new public holdings, of course, index has to be adjusted or the revised to be in order to represent the latest public holding percentages. Therefore, the index weights should be recalculated after each quarter, which is known as, in this parlance, which is known as rebalancing the index. So the change number three would be rebalance. This would require rebalancing. Currently, it is not applicable. However, in the proposed methodology, there would be quarterly rebalancing. Or in other words, there would be 4 rebalancings in March, June, September, as well as in December. And so that the rebalancing means the weight revision of each constituent based on the recently disclosed public holding data. You would clearly understand the requirement of it. Once the companies disclose new public holding data, the index has to represent that. Therefore, it has to be adjusted. And the rebalancing would take place, of course, in March, June, September, and December. Remember, 3 changes. One is weighting scheme change. Number 2, capping. Number 3, index rebalancing, or rather quarterly rebalancing. And so this table will help us understand what this rebalancing, how the 4 rebalancings would take place in a given year. The rebalancing of quarter 1 would be based on the public holdings of the previous quarter, obviously. And so it is carried out on March. We have a specific date of third Friday of March. And so that will be effective on the following Monday. And of course, when it comes to weight reconstitution, we have to be based on a particular day. And for that is known as rebalance reference date. Reference date would be last trading day of February. Likewise, I mean, the other rest of the table is self-explanatory. And this is how the rebalancing would take place. So that there would be 4 rebalancings in each year. Right. So once this is launched, what would happen is, of course, there won't be any sudden shift simply because of this introduction of new change. There won't be any sudden shift. And of course, it would continue from the previous point. For example, by the time we launch this revision, prior to that, index closed at, say, 13,500, for example. Following day, once this is implemented, of course, index would start continuing from 13,500. The serial continuity would be maintained. However, this would be thereafter will be calculated on a different basis. Of course, earlier that was calculated on full market capitalization basis, but hereafter, once it is introduced, of course, it will be calculated on the float adjusted market capitalization. And thank you very much. I believe I was able to set some context for the discussion. And over to you, Dimanta.
Thank you, Nishant, for that insightful presentation. So we actually looked at keeping the presentation short in order to answer a higher number of questions that we have received. So we have received actually a large number of questions, and we will go into the questions sequentially, starting from the basics and going deeper and deeper into how the SPI calculations are taking place, and what are the impacts of its advantages, disadvantages. So we'll be covering the whole gamut of questions that we have received. So let's straight away move into the question and answer session. So Nishanta, my first question to you is basically we're going to start from the very basics. Nishanta, if you can explain what a stock market index is. Let's start from there, Nishanta.
Yeah, thank you. I think that's a good start, because first of all, we should understand what the purpose of stock market index is. Now, when it comes to understanding the overall direction of the market, of course, in this regard, indices would be helpful. Not only that, and when it comes to understanding the market return, of course, in this regard, also in the stock market indices would be helpful. If I may go inside, I mean, dig deeper in that regard, how do we calculate market return? Of course, it's nothing but the percentage change of the two indices at the end of the year as well as the beginning of the year. What would be the rate of change? And for example, say if it is, if I may pick the real exact numbers, of course, ASPI had given 80.5% return last year. Is nothing but the percentage change of the closing index as well as the opening index. So that's clear. So that will help us understand what the market return is. And the other one is market's direction. And if the indices are going up, of course, we call it a bull market. That means in general, prices are going. It doesn't mean that the prices of each and every stock is going up. Of course, some prices would go up, some prices would go down. However, depending on when it is weighted on the size, the overall impact towards up. That's why we call it market is up. And if the indices in this index values are going down, of course, we call it a bear market. That means, in general, the market sentiment or market price direction is towards down. So those are the two main indices, two main purposes of the index. There are some other purposes as well. For example, we can trade on index, we can create index funds and so on. I think those are less relevant for this discussion, so that I limit the purpose of stock index to those two, Dimanta.
Okay, thanks a lot. Thanks a lot. This decision to changing the ASPI, Nishanta. Now, most investors have this sort of question as to why this index is changed to so suddenly. Is it a sudden decision, Nishanta? Now, does the CSE have a sort of a process in doing things? Could you explain to the public what type of process actually takes place within the CSA in terms of when such a big decision is taken and whether it's actually a sudden decision?
Yeah, announcement may look somewhat sudden, but however, the process is not sudden. It's well thought a decision. Actually, it took more than half a year for us to go through this process. Now, when it comes to changing index methodology is not something new, right? Of course, now there is an internationally accepted good practice in that regard. The practice is that actually we should recalculate, we should reconstitute the index as if we are introducing this change some time ago, say 10 years ago, like 8 years ago, and so on. So that we went back to 2013 and we recalculated this particular index, new index, or the index value based on this methodology, as if we did that in 8 years ago. So that then we had two indices. One is the recalculated index. Other one is the ASPI, actual ASPI value that has been available. So that then we were able to better understand the impact of this methodology, and what are the things that we need to consider, what are the parameters, and how it should be reconstituted, and how we should be capped by 5% and not something else, not at a different rate, and so on. So that particular exercise, which we call back testing or back checking, they were helpful in that regard. So that's how it was actually done. So that this may look, as I mentioned earlier, the decision or the announcement may look somewhat sudden. However, the process that we underwent is not sudden.
Yeah. So basically, there is a long process in terms of basically doing these things, and there are no sudden decisions taken in the CSE. So everything is a well thought out process and back tested as well, and then put into the public. So let's move into the next question. So now. So there was a significant movement in the ASPI, especially if you take during last year, certain times we've seen unnatural boost in the ASPI also happening. Now, do you think that the CSE thought there is a sort of a defect in the ASPI calculation methodology? Or now, if you take globally, do you think both these methods are used in index calculation? Is there a defect in the current calculation, Nishanta?
Yeah, I think that question has two parts. One is what the empirical evidences are. If I may first answer that question, of course, this idea came into picture in somewhere in 2000, 2001. The float adjusted, the fact that indices can be weighted on float adjusted market capitalization. And soon after that, stock exchanges started converting the indices into the float adjusted basis, because that gave a better picture than waiting on total market capitalization. And with regard to the recent the higher returns, that's partly because of some sort of a problem in the current ASPI calculation. As I mentioned, what happens is even for a any change, so we consider that the impact to the entire company. For example, let me quickly explain that with a hypothetical example. Say we have a company with market capitalization is 100 billion, and so that say the particular company's public holding is 1%, which is not obviously good enough, right? That means only 1% of that would be available for the for public to trade. That means in terms of value, of course, 1 billion is the total market capitalization, 1 billion is the float adjusted market capitalization. What we do, we weight the entire index, the particular index, based on the total market capitalization, so that we weight that based on 100 billion. And of course, so that will inflate the market. So that this higher return is partly because of the current index market capitalization methodology. Once it is weighted on the publicly available portion, or in other words, the float adjusted market cap, it will not be that high. It will be proportionate to the publicly available quantity. Therefore, the new methodology would represent the tradability of the stocks. Otherwise, what happens is, if I may further explain that, say when investors see a particular company giving higher return, of course everybody wants to have higher return, because in this inflationary environment, that's something that everybody would expect. Then of course everyone would rally around that company. And what would happen if that company's public holding is very small? Of course, when investors are interested, it would create a demand. However, if the public holding is low, supply would be constant. Supply would be small and constant. In that scenario, of course, what happens is the prices would go up. When the prices start going up, more and more investors would come in. It will create more and more demand. However, supply would be constant. And as a result of that, prices would be skyrocketed. Of course, then it would start giving some higher return, which may not be that realistic. The investors may not be able to realize that return. Why? Because although the prices are going up, of course, then they are not able to they are not able to realize that return. That's what I mentioned as this doesn't represent the tradability. Once it is weighted on the float adjusted quantity, of course, there would be some return, some good return, some decent return, which is realizable. Of course, you can realize that. And so coming back to your question, of course, this high return, partly because of this weighting scheme, which we are going to correct.
Nishanta, so both methods, is it globally used, both of these methods?
Both of these methods are used. However, the trend is moving towards the float adjusted market capitalization. Only very few stock indices that can be found still that are based on total market capitalization. Most stock indices are based on float adjusted market capitalization. For example, if you take the index service providers like FTSE, S&P, Dow Jones, all the index companies have adapted this methodology long ago. I mean, since the concept was introduced in early 2000.
Okay. Nishanta, you were talking about the free float and sort of the float adjusted market capitalization. Now, if an investor wants to know what it is and or even find out a particular company's float adjusted market capitalization. Now, is this information publicly available?
Yes, the information is publicly available, and the float adjusted market capitalization, as I explained earlier also, the publicly available portion that is expressed as a percentage. Who calculates that? How it is calculated? The company itself would calculate the public holding. And sometimes this is known as free float also, free float, public holding, and both those are used interchangeably. And but the official document of the definition says public holding, public holding. And I would say the free float is sort of a generic name. And so how this is calculated is, if you take the entire issued quantity, entire issue, total issued quantity, it would be 100%. Now, from this 100%, we should eliminate strategic holding. For example, say the founding family, right, holding 35%. Would they trade that in the market in general? Can we expect them to trade that in the market in general? No. Therefore, that 35% will not be available. So we subtract 35%. Out of 100%, now 35% gone. Then again, chairman is holding another 20%. Would the chairman sell that in the market rate? Of course, if he needs, he can. But in general, would he do that? Unlikely. Therefore, that is also will not be available for public to trade. And that is also gone now. 35, 50, 45%, right? 45. Likewise, we keep on deducting the strategic holding. Once we stop deducting, of course, then we are left with some portion. That portion is called public holding, and that is what is available for public to trade. And how do we identify strategic holding? There's a particular definition. That definition can be found in the CSE website. And when it comes to the public holding data, of course, companies would disclose them in their quarterly financial statements. Quarterly financial statement, if you download that, and if you can do a simple search, public holding, of course, then they would have disclosed that, and they would keep on disclosing that on quarterly basis, right? Quarterly basis. And on top of that, if there is sudden shift more than 2%, immediately they need to disclose that to the market. For example, last quarter, what they disclosed is 35%, and somewhere before the next quarter, if that goes up more than by 2%, so then they need to make immediate disclosure. Other than that, of course, that would be reported in the next quarterly financial statement.
Okay. Yeah. Okay. Great. Thanks for that detailed explanation. Now, there's a particular question regarding this free float. What it says is the public float number of certain companies seem not to exclude stakes held by a government of Sri Lanka. So the investor thinks ideally this should be adjusted for. Will the CSE adjust for these prior to implementation of the float adjusted index?
Actually, earlier I happened to mention about the back testing. We went back to 2013. And you would have thought, why 2013? Why not 2010? Or why not some other? Of course, why we went back to 2013? Because that was the year where the current definition of public holding was in effect. So that was a good point for us to start. Likewise, there is a particular definition for public holding. So that has been there for last 8 years. Of course, that was changed in 2013. Even that was there even before that the new definition was in effect in 2013 onwards. Likewise, there's a definition. So this is calculated based on the definition, so that it doesn't talk about whether the government is holding or not. So the definition tries to clearly identify the strategic holdings. So we keep on deducting, we keep on removing all the strategic holding. Once it is done, we are left with some portion. That portion is considered as public holding. So that it is strictly based on the definition. Right, and also it is self-disclosure. Self-disclosure means it is the company that would calculate and disclose. So that CSE would audit them, and once it is calculated, whether it is in line with the definition or not. If it is not, of course, it could be immediately brought to their notice and would be corrected.
Okay, great. So let's go into the next question. It's regarding. Basically, again, regarding the free float rules that the CSE has. So there are some listing rules regarding free float, but still there are a lot of illiquid counters in the market. So the question is, isn't it better to properly implement the free float guidelines rather than adjusting the index? So that is the question that is asked. Yes, Nishant.
Yes, I think that's a good question. Basically, the question asks about the enforcement of the public holding rules. As you know, when it comes to the Reserve Board, of course, you have a initial listing requirement, public holding requirement, and there is something that the company is to maintain on ongoing basis. Likewise, for the main board also, there is initial public holding listing requirement, as well as there is something that they need to maintain ongoing. As you know, there are so many companies that have not met this requirement. That's why we found sometimes companies with public holding less than even 1%, sometimes 1%, right? 1%. And imagine, hypothetically say that every company has met this requirement. Every company has met this requirement, minimum requirement, right? So still we need this kind of index, because the index return should be proportionate to the publicly available quantity. I think both are required, right? Both are required. Definitely, the companies are to meet these requirements. That's a different part. This doesn't solve that. Simply introduction of this one will not substitute or will not offer any solution for that problem. That has to be separately addressed, and that's the enforcement action should be taken. And on top of that, of course, it's good to have this kind of index, because this kind of index would then represent the tradability of companies, as well as it would give some realistic return that would be sustainable.
Yeah. Thank you, Nishan. So very clear answer. The simple answer is that both are required. Listing rule enforcement is also required, but this change methodology, according to global standards that are currently trending, is also required, is the answer. So going forward, now there's questions now regarding this change. Now, how will this change actually affect the market? Will there be an impact on the market by this ASPI change? Is there an answer for that? Because now another question, I'll combine it with that question as well. Because the question is, isn't it preferable to rebase the index several years back, so that the public has a sort of a track record with that? Now, because we don't have that, we don't know what kind of effect this will have in the market.
Yes, as I alluded earlier, of course, we have compiled this index from 2013 as if we introduced that back then. Then, of course, we have done it, and so that we have very good understanding about how it behaves, right? How we should work on the other parameters, like how we should be reconstitute or rebalance, right? How we should be rebalanced, and so everything has been understood very well. That's why it involves a tremendous amount of work, because we were to compile the index and we dealt with close to 2,000 corporate actions, adjustments, and so we have done that, right? We have done that. And when it comes to introduction of this methodology, of course, the trend or the generally accepted principle is that we never introduced the revision of methodology with sort of a retrospectively, right? Yeah. And of course, we introduced that from the current date towards the future, right? Towards the future. Although we did back calculation, that is for us to understand how these parameters are behaving with regard to calculations. And we have done that, and we introduced, and that will be effective from that point onwards.
Previous changes, Nishanta, were they also done in the same fashion?
Sorry?
The previous changes to the ASPI, I think in 2013 also you did a change. Was that also from a particular date, or was there a previous calculation done?
Actually, that was a very special scenario because now ASPI methodology, we have introduced 2 revisions. This is the second revision. Before that, we had done 1 revision. And after the introduction of ASPI in 1985, the very first revision was introduced in 2017, June 19th. That was to include the non-voting shares to the index calculation. Till then, we considered only the voting shares. And globally, the definition commonly it was generally accepted that the market capitalization should include not only voting shares but also non-voting shares as well. So that in order to be in line with that definition change, of course, we included non-voting shares to the market capitalization, and parallel to that, we introduced non-voting shares to the ASPI as well. That was the first revision, and here what we are discussing is the second revision. So that now you would have understood that the previous revision, of course, for that purpose, of course, we don't want to do any the back testing, because that is as if we are listing a new company, right? So that we introduce all the non-voting shares, and we introduce 17 non-voting securities on that day. And so those, I mean, you can consider them as a sort of a 17 new listings, right? So that is a special case which didn't require any back testing.
Okay. Great. So a lot of people ask, from when this is done, and whether there's a sort of a base year that you all use. Shall we explain from that perspective, that whether there's a base year sort of thing that comes in this scenario, Nishant?
Right. There is no base here. Why? Because we are not compiling any new index. Remember, this is not a new index. This is a methodology change. ASPI would remain as it is. Still, even after the introduction of this change, the name itself would be Whole Share Price Index. Whole Share Price Index, or in short, ASPI. So that is not a new index, not an introduction of new index, same index, but only a methodology change. Therefore, there won't be any base year. Base year, of course, would remain as the current base year, right? 1985.
Okay. Great. So there's no such thing as base year.
No.
If today the index is close is 13,000, tomorrow the opening will start from there.
Exactly.
So there's a question on the indices. So whether there will be a replacement of the ASPI, whether there will be another ASPI like the old ASPI or the new ASPI. Can you give an explanation as to how from the date that the new methodology is introduced, are there going to be two indices, or is it just one and the same?
Right. There won't be two indices. Right. There could be two indices if we continue using the old methodology, and if we start compiling that, and this was introduced as a separate index. So as I mentioned earlier, there is no such thing. There won't be new index. Therefore, we continue with the same index, ASPI, and this is only a methodology change. Therefore, even after the introduction of this methodology revision, there will be one index, which is ASPI.
Okay. So what are the main advantages that the new methodology is going to give that the old methodology is not giving? And is there any disadvantages in the new methodology as well that the CSE have noted?
Mainly, if I may talk first about the advantages of this one, the main advantage would be the index returns would be more realistic and realizable. Why? Because those are generated from the publicly available number of shares. The returns are proportionate to publicly available the quantity of the market capitalization. Therefore, those are realizable, and we call it the index would represent the tradability of the market, or the index returns would be more realistic, and therefore those would be more sustainable. And those would be the main advantages. If I may talk about disadvantages, now that you asked about disadvantage, there is a disadvantage as well. However, I must clearly mention that particular disadvantage doesn't apply for the local investors. Actually, that is applicable for the global, the foreign investors. Imagine a situation where a foreign investor is focusing on 2 markets, 3 markets, and they are focusing on, ideally, those exchanges should have float adjusted market indices. However, those should have been based on different methodologies. For example, if we take ours, right, public holding definition is homegrown, Sri Lankan one. The methodology, homegrown, our one. But if some other market, right, if they are using their own public holding definition, of course, it should be slightly different, and they would have different norms. For example, Bombay Stock Exchange, they always public holding percentage, they always round it off to the nearest 5%. Right? It is Sri Lanka, we go by 2 decimal places, like 36.75%, something like that. But there, either it is 35% or 40%. Then, likewise, there are different norms. Right? When the different stock exchanges use different methodologies, such an investor, foreign investor focusing on all these markets would be in trouble because they will not be able to compare. Why? They are based on clearly different methodologies. And of course, for them, of course, they are sort of a disadvantage, but it's not actually not applicable for the local investors. And so as far as local investors are concerned, you are in very good shape as far as this new one is concerned. And also when it comes to foreign investors that I referred earlier, of course, there are solutions for that. One is of course they are not focusing on this kind of the broad market indices. They are based on the blue chip indices. Mainly blue chip indices are based on international index providers like S&P SL20. For example, so Colombo Stock Exchange has S&P SL20. S&P, that is based on S&P methodology. Methodology is the same. Public holding definition is the same. And so they have sort of index in Bombay Stock Exchange. Still, that is S&P. Likewise, when the index service providers are there, of course, even that disadvantage for the foreign investors also would be reduced.
Okay. Thanks. Thanks, Nishant. You actually answered 2 questions. There was a question on regarding the Bombay Stock Exchange as well, with that methodology, that rounding off is was going to be adopted for Sri Lanka as well. So you already answered that question, that it's not going to be as such. So we'll go into the next question. Now, there's a question regarding what is the difference between the price return and the total return index. So is there going to be a change? I think the SBI has a total returns index as well. So is there going to be a change there as well? What is going to happen there, Nishant?
Yes. If I may first explain what these 2 indices are, as the name implies, price return means the index percentage change would give us the price change. I mean, the return that we have or the investors have generated simply because of the price change. And so that's the purpose of the price index. Now, there are 2 sources for investors. One is, of course, capital gains or the price change. Other one is, of course, companies would have paid you dividends, which we call dividend return. Dividend return. Now, think of putting them together, price return plus dividend return. That is known as the total return. Total return, in very simple equation, total return is equal capital gain plus the dividend return, or in other words, price return plus dividend return. And any price index would have its corresponding total return version also. Do you know that S&P SL20, everyone is referring, but that's a price index. Do you know that it has its own total return version as well? It's not that popular, but that's there. Right? Any stock exchange that would publish any price index would have published its own corresponding price total return index as well. Likewise, SBI also has its own total return version, which is known as ASTRI. Sometimes we pronounce it ASTRI, All Share Total Return Index. Total return index. So parallel to this change, of course, this particular revision would be inherited to that index as well. Yeah. it would be therefore the change would be there for that index as well.
Okay. So in the calculation methodology, you've explained, Nishant, in your presentation that you've put in certain conditions, right? I think one such thing is a couple of things: the capping, the rebalancing, those areas, right? So let's start off with each of the things. If we first start off with the capping part, can you again explain as to why such a capping is done, and is there an advantage in such a capping, and what happens to the market return in such a case? Yes.
Right. So that question has several components, right? If I may first, so I invite everyone to check the highest index weights in the current index in the sense total return, the ASPI index, right? ASPI index, and also you can check historically. The highest representation is around 7%, right? 7%. But when it comes to float adjusted market capitalization in the proposed methodology, now that we are going to weight index constituent companies based on the float adjusted market capitalization, certain companies stand out in the sense they are in very higher position. And imagine a very large company having 98% public holding. Of course, multiplication itself would be much larger. And among float adjusted market capitalization, those would be very large companies, right? Large companies. If you take the weight, of course, now their representation would be much larger. Historically, sometimes that comes to slightly above even 25%. Imagine one company, one index constituent representing 25% of the index, 26%. I remember certain years certain quarters that was 28%. That means that is known as over-concentration issue. This is identified as a problem in index calculations, over-concentration. That is good actually when that company is doing good. Of course, then the index would go up. What would happen in the bear market? Of course, when that company is coming down, of course, then index would be badly impacted. Therefore, this how the overconcentration issue is addressed in this index calculation or index mathematics is that we simply limit the highest representation, that is known as cap. We cap the maximum representation in a particular index. Then capping at what percent? Whether it is 5%, 7.5%, 10%, right? And of course, that is actually the result came from the backtesting. That's what we learned from our backtesting exercise. And we realized that it is the 5% capping that had given the best or the return in both markets, because we should be mindful about both markets. We should not focus only in bull markets, only in bear markets. Right? So hence the 5% became the best choice. We have tested 5%, 7.5%, 10%, 12.5%, 15%. Right? And we have tested all these 6 cappings, and out of which we learned that 5% is the best, and we went ahead with that. And that's how. When it comes to return, of course, we have made sure that so this gives a decent return in both markets. So there is no impact in this capping. Actually, it's a sort of we have safeguarded you, right, from the concentration, over-concentration issue.
Okay. Yeah. So there could be huge biases into or concentration into certain shares, and this sort of prevents that
exactly.
High concentration into particular shares. So,
Hemanta, can I add something more to that? Otherwise,
yes.
it would be incomplete. Now, when I say we are capping the highest representation at 5%, it doesn't mean that we maintain that on ongoing basis or real-time basis, daily basis. Remember, as I mentioned, we reconstitute the index 4 times a year, right, which we call quarterly rebalancing. At each rebalancing, we bring it down to 5% if it has gone above 5%. Right? Thereafter, we will release it. It's market to take any. The following day itself, it might become 5.1%, 5.2%, 5.3%, 6%. Let it go. But in the immediate next rebalancing, we are bringing it down to 5%. Right? That's how we cap that. So we should not be misunderstood as ongoing basis, daily basis. We are maintaining the cap. Cap is enforced at only other rebalancings.
Actually, you answered my next question also, Nishanta. So the question was basically, if it's limited to 5% and the share moves, whether the ASPI would move at all, right? So that explains the situation. So it's only rebalanced to a particular day. After that, the index will move depending on the share.
Exactly.
movement, right? So the next question is regarding this rebalancing. How does this rebalancing happen, Nishanta? When do we start the process? And so can we have a detailed explanation? I know you did it very briefly in the presentation. Can we go into a bit detail here?
That if I may, very high level terms explain what rebalancing means. The index weights should be reconstituted because companies would have disclosed new public holdings. At new public holding, for example, once the companies disclose their, they stop compiling their Q1 reports. Of course, in that report they would have disclosed new public holding data because index has to absorb these changes, right? So that we recalculate the index weights. So that has to be happening at March, June, September, and December. And for that, of course, now we have set all the dates, right? Now you can determine how the quarterly Q1 rebalance in 2026. Of course, if you can have a calendar, you can find out the day. What's the day? 3rd Friday of March. Right? And when would be the June rebalance of 2027? Of course, it would be 3rd Friday of June. If it happens to be a holiday, of course, prior day. Right? Likewise, it's always 3rd Friday of March, June, September, and December. And it would be effective on the following Monday. So the Q1 rebalancing or the new weights, let me put that way rather than using the word rebalancing, new weights would be incorporated to the index from the 4th Monday of March, 4th Monday of June, 4th Monday of September, as well as 4th Monday of December. And that is how it is done. So that but in that particular day, you won't expect any index level change, right? Index level change, that's obvious, right? This only the weights change. There is no reason. It is not a reason for the index to move up or down simply because of that. And index, the serial continuity would be maintained. While maintaining that, the index weights would be revised for the upcoming quarter.
So Nishant, if we take a quarter now, let's take the current quarter for simply sake for the investors to get an understanding. Now, 31st of December, the one quarter ended and we are in a new quarter. And by the 15th of February, we will have all the quarterly results being released and all the public holdings will be public knowledge. And then where do we do the rebalancing?
Rebalancing, of course, now Q4.
Taking the current quarter, yes.
Yeah. For example, now Q4 is a special case. Why? Because for that, for the Q4, companies would get 60 days. Whereas all the other quarters, companies would get 45 days. Therefore, for the Q4, they would get 60 days. That means end of February, the companies would have published their public holdings. And as per the schedule, the rebalancing would take place 3rd Friday, right? 3rd Friday of March, right? 3rd Friday of March. For example, Q1 rebalancing of this year would take place the March, third Friday of March. It should be around, I don't know, it could be around 17, I don't know. Right?
Third Friday of March is 18th of March.
18th, right? 18th would be the rebalancing date. And the new weights would be applicable for the following Monday. That means 19th is Saturday, 20th and 21st. Right? 21st morning,
21st of Monday.
Index would be calculated based on the new public holdings that companies reported in the Q4 of the previous year.
So, yes. So that's important. So basically all these things have been taken into consideration when determining these dates. So when the financial year ends, it takes 2 months or 60 days for companies to release their quarterly results. So that is applicable for 31st of December, and that is applicable for some cases 31st March companies. So that's why we've basically we are doing it on the third month of the quarter, right? So then the next question is on the S&P SL20. Now, is there any change going to happen to the S&P SL20 also? Now, are these happening in two different calculations? Is the question, or is the calculation similar?
How do I put that? Let me put this way. Now, S&P SL20 is a result of a collaboration that the Colombo Stock Exchange has with S&P Dow Jones Index Company. And now that it is coming out of the international index methodology, of course, it has been based on the float adjusted market capitalization from the inception of 2012, right? 2012. And that is also kept at 15%, right? 15%. And of course, there is no connection with this revision and that had been based on anyway on float adjusted market capitalization. All these components are there, like rebalancing, capping, all the components are there, and there is no connection and there is no change in that regard. This revision is only with regard to SPI.
So Nishanta, if a particular investor wants to say study the methodology in the of the ASPI, where can he get the information? Is it available in the Colombo Stock Exchange site? Where exactly can someone get an understanding there?
Yes, very good question. As now, with regard to this index calculation, of course, transparency would matter a lot, and of course, anyone would be able to replicate this index. Why? Because this is based on publicly available information, right? And so we have published detailed methodology document in the CSE website. There, of course, you can have deep understanding about this definitions, the rebalancing schedules, the rebalancing reference dates and everything. And if you go to, I think, investor, the stock exchange website, investor tab, you would be able to find the detailed methodology document of the stock exchanges index methodologies.
Right. Okay.
And also, last page, of course, we have given the contact details. If you need any other clarification, further clarification, by the way, that would be very detailed. And still, if you need some clarification, of course, we have included our contact details. The investors or the interested parties can reach us.
Right. Yeah. Then, so in terms of the market volatility, so some investors are worried that there will be extremely low market volatility because this ASPI change is happening. You have already done your back testing, Nishanta, over the last for the last 5-6 years. So is that true that there's going to be extremely low volatility, or what is your experience that from the back testing that you've received?
I would say the volatility would be lesser, but it's not at all extremely low, right? Still, the decent level of volatility would be maintained, because for you to make money, of course, in the stock market, in the secondary market, there has to be some level of volatility. What is not that healthy is the unusual volatility, but unusual volatilities will not be there, but the decent level of volatility would be there in the market.
So now, if there is a reduction in volatility, are you also considering changing the market closure methodologies, or what he's basically asking is there is certain triggers when the market falls by 5% and so on. So are there going to be any changes in these methodologies as well? Are you all considering something like that?
At the moment, we haven't planned anything in that nature. And going forward, if needed, of course, we might consider them. So the short answer is, for the time being, we haven't considered any change in those regards.
Yeah. So we've received one final question, actually a new question. It's asked, I think part of it you've already answered. The question is, what is the methodology to calculate public holding, especially in a case where main shareholders sell small quantities in the market, which doesn't require any disclosure? Is this process automated?
I think, as I mentioned earlier, the public holding is calculated by the definition. In very high level term, definition is 100% minus certain well-defined categories. Okay, we deduct this one, we deduct the other category, we deduct the other category, depending on the is a lengthy definition. Even the definition can be found in the CSE website. I think I mentioned that earlier also. And with regard to, of course, public holding might get changed. For example, chairman might sell it off, right? Smaller portion, right? Smaller portion. Now we have, we want the investors to make, I mean, the disclose, make a public disclosure. Not the investors, actually. It is the company that should do that, and the company should disclose if the public holding has changed more than, if it is changed more than 2%, right? 2%. Other than that, the public holding is not calculated based on small trades or ongoing basis. Ongoing, it's a kind of a stock taking, right? Stock taking. We don't do stock taking every day, right? It's done periodically. In this regard, of course, the companies are to recalculate this quarterly basis and disclose. Ongoing basis is not calculated.
Yeah. So the CSE has set up a standard there. 2% is the standard that CSE has set, and if there is any change beyond 2% is what is
public disclosure required. Yeah.
Public disclosure that is going to be required. Yeah. So thank you, Nishanta. I think we've answered all the questions that have come through the Google form, and we hope that everybody has got a deeper understanding as to how this is going to happen. And so the first change we are likely to expect in the month of March, and everybody will be looking forward to that. Any final comments, Nishant, for the investors?
Investors, of course, what they should expect is a new methodology change. Don't expect a new index. We don't compile, we don't publish any new index. It's simply, I repeat, that is only a methodology change. Still, even thereafter, the name would be all share price index, right? And after some time, if you look back, that particular launch date would be a historical day in the journey. That's the thereafter. I mean, that's the methodology change. Right? Methodology change. Other than that, there is no rebasing, no new base date, no new index, nothing. It's only a methodology change, and it would continue from the where I stopped at the before the launch, as well as it would, but it would be calculated on a different basis. You know what the basis is now. The index constituent would be weighted on the float adjusted market capitalization. Remember, capped at 5%. The maximum representation would be capped at 5%, not ongoing basis, but at the time of each rebalance. So it can go anywhere, but 4 times a year, we bring it back and we capped at the maximum representation would be kept at 5%. I think so that's the summary that I want to give you, Dimanta.
Okay, right. So very clear answer. There's no change in the ASPI numbers that is going to happen. The ASPI would just go on as it is. Only at a particular date, specifically it will start from the third Friday of March, a methodology change would happen. So from that day onwards, the calculation methodology only changes, the index goes as it is. So very clear, see the Colombo Stock Exchange is very clear on that. And so that comes to the end of our Q&A session. Thank you very much, Nishanta, for providing your insights and making our investors more knowledgeable on this change. And this is the second webinar that we are doing after the announcement of the revision calculation. So we have come to the end of the webinar, and we would like to extend a warm good night to all of you, and thank you very much for listening.
Thank you, Dimanta.
Thank you.